Hello everyone, Alex Kim here. Silver printed 109.46 during Asian trading hours on Monday, marking a fresh all-time high on the XAG-USD pair. This wasn't a technical anomaly or a flash quote error. This was verified price action representing the third consecutive session of gains, and the metal is currently consolidating around $108 after briefly testing that level. What matters isn't the headline number itself, but what the structure underneath is signaling about demand, supply constraints, and how institutional positioning is evolving at these extremes. The technical framework shows price trading firmly above the 50-day exponential moving average, which currently sits at 74.67. That's a substantial premium, roughly 45% above a medium-term reference point that typically acts as dynamic support in trending markets. The 9-day EMA is at 96.32, and the widening gap between short-term and long-term moving averages indicates momentum acceleration rather than exhaustion. When shorter averages pull away from longer ones at this rate, it reflects persistent buying pressure that isn't being absorbed by normal profit-taking. The 14-day relative strength index is at 80.24, which places silver deep in overbought territory by conventional definitions. Standard technical analysis would suggest this creates conditions for mean reversion, but that interpretation misses how RSI behaves in strong trending environments. Overbought conditions can persist for extended periods when the underlying trend has structural support rather than speculative momentum. The RSI staying above 70 confirms that upside pressure remains dominant, not that reversal is imminent. What changes the interpretation is whether buyers continue to step in during shallow pullbacks, or whether profit-taking accelerates into selling pressure. So far, the behavior has been accumulation-oriented. Price is trading within an ascending channel pattern, where the upper boundary currently aligns with the $109 to $110 zone. That's exactly where the recent high stalled, and the candlestick formation near this level shows smaller bodies with upper wicks, which indicates consolidation rather than rejection. When resistance is tested multiple times without a breakdown, that's absorption, not weakness. Sellers were present but couldn't push price materially lower, which suggests buying interest remains elevated even at these levels. The mid-channel trendline sits around 103.30 and has acted as dynamic support multiple times during this rally. This level also coincides with a prior breakout zone, creating confluence where multiple technical factors align. Below that, the next major support sits in the $97.80 to $98 range, where the lower channel boundary meets previous resistance that has turned into support. As long as price holds above this zone, the bullish structure remains intact. From a risk management perspective, the setup allows for defined downside with asymmetric upside potential. A pullback toward the 9-day EMA around 96.32 wouldn't damage the trend. It would reset momentum indicators and create healthier conditions for continuation. The $109.50 to $110 zone represents a psychological barrier where options dealers hedge and round number resistance naturally attracts sellers. If price fails to break through decisively in the coming sessions, deeper consolidation toward $100 to $99 becomes more likely. External shocks, whether from a sudden dollar spike, hawkish Fed positioning, or a broader liquidity event, could trigger risk-off moves that temporarily drag precious metals lower even when fundamentals remain supportive. March 2020 demonstrated that even assets with strong structural demand can get sold when leveraged participants need to raise cash. But none of these risks change the underlying trend structure. What's different about this rally compared to previous spikes is how price has behaved during pullbacks. Instead of triggering liquidation cascades, dips have attracted buyers. That's accumulation behavior, and it's what you see when institutional money, or sovereign buyers, are building positions rather than when retail speculators are chasing momentum. The recent pullback from 109.46 has remained shallow. From a Fibonacci perspective, price is holding well above the 0.382 retracement of the latest impulse leg. In strong trending markets, corrections tend to happen through time rather than price. The market consolidates sideways, digests gains, and then continues in the direction of the primary trend rather than retracing deeply. This isn't speculation. This is positioning. The macro backdrop supporting this move includes a weaker US dollar, easing real yields, and persistent geopolitical uncertainty that shows no signs of resolution. These are structural forces that support precious metals' demand over quarters and years, not transient factors that reverse within weeks. Silver benefits from higher volatility relative to gold because it's a smaller, tighter market. The same capital inflows that move gold 2% can move silver 5% or 6%, which creates embedded leverage in the asset itself. Beyond monetary demand, industrial consumption continues to tighten the physical market. Solar panel installations are scaling globally. Electric vehicle production is ramping across every major manufacturer. 5G infrastructure build-outs are accelerating, and defense applications are consuming silver at record rates. Every one of these trends requires silver in quantities that current mine production cannot satisfy. The Silver Institute's data shows annual deficits around 100 million ounces, when all demand is accounted for against total supply. That deficit has to be filled from above-ground inventories, and those inventories are not infinite. Each year the deficit persists, the cushion gets smaller. When that cushion runs out, price doesn't adjust gradually. It gaps because industrial users cannot shut down production lines. They will pay whatever is required to secure supply. This is supply and demand mechanics that anyone can verify, not narrative-driven speculation. Are you seeing the same technical setup in platinum or palladium, or is silver moving independently at this point? If you find this breakdown useful, consider subscribing so you can follow how these signals develop. The levels that matter going forward start with initial support at the 9-day EMA around $96.32, followed by the lower boundary of the ascending channel near the psychological $96 level. Any pullback into this zone should be treated as corrective, as long as the longer-term average continues to rise. The 50-day EMA at 74.467 offers deeper support, but if price reaches that level, something fundamental has changed in the macro picture. That's not the base case. That's the scenario where broader risk-off conditions override metal-specific demand. On the upside, $110 is the critical level. A clean break and sustained hold above this psychological barrier would signal trend continuation and open the door toward $113.50. Beyond that, the upper channel projection points toward $118.40 as the next major target. From current levels, that represents potential upside of $4 to $10 if resistance breaks, which is significant for anyone positioned in physical metal or long-dated options. The framework that makes sense in this environment is buying pullbacks toward the $103 to $100 support zone with targets at $114 and stops below $97 or $80. That structure offers defined risk with favorable asymmetry, risking roughly $6 to $10 on the downside for potential gains of $10 to $15 on the upside. Position sizing, risk tolerance, and time horizon are factors only individual participants can determine based on their own constraints. What the 109.46 print represents is not just a price milestone, but a signal about market structure. Demand is overwhelming supply at levels that were supposed to act as resistance. Buyers are not waiting for pullbacks. They are chasing, which indicates urgency. Somewhere in the world, whether industrial users, sovereign entities, or large institutional allocators, someone is accumulating silver aggressively. When you see buyers paying record prices because they believe even higher prices are coming, that reveals information about expectations that aren't reflected in mainstream commentary. The narrative for years has been that silver is simply an industrial commodity with abundant supply, that precious metals are relics, that digital assets and technology equities represent the future, that inflation was transitory and the dollar was structurally strong. That narrative is being tested by market reality. Silver at all-time highs, gold at all-time highs, central banks buying precious metals at the fastest pace in decades, de-dollarization accelerating across emerging markets, debt levels spiraling beyond historical precedent. The gap between official narrative and observable market behavior is widening. When that gap becomes unsustainable, repricing doesn't happen gradually. It happens violently and fast. Watch the flow, not the headlines. Silver hitting 109.46 reflects structural demand colliding with constrained supply in a market that was designed for conditions that no longer exist. The technical trend remains intact. Fundamentals are supportive, and momentum is strong despite elevated RSI readings. The risks are real. Corrections will happen. Volatility will test conviction. The $110 resistance zone may reject price in the short term, but pullbacks within a rising channel are buying opportunities, not sell signals, as long as key support levels hold. The market is signaling that buyers are urgent, sellers are scarce, and the old equilibrium is breaking. Whether this resolves through a breakout above $110 or consolidation back towards support, the direction of the primary trend is clear. We don't know if the $110 barrier breaks this week or next month. We don't know if the current consolidation is the final pause before continuation or the start of a deeper pullback. We don't know how central banks, bullion banks, and institutional players will respond to silver challenging triple-digit territory. What we do know is that the setup is asymmetric, the fundamentals are aligned, and the market is behaving in ways that suggest this is not the end of the move, but somewhere in the middle. The public narrative lags the positioning. What part of this move do you think institutions are managing differently than retail participants expect? Leave your thoughts in the comments, and I'll be back with more analysis as these levels develop.